Good evening, ladies and gentlemen.
Good evening.
Good evening.
Yeah, I'm happy to welcome you guys tonight for this very important section. It's a very interesting one, not just because of the topic, but because of the person handling the topic. It's one person that is very dear to S&P Finance Club heart. If if S&P Finance Club has any, anyways.
Yeah.
She's one of our founding members, one of the leaders behind the scene, doing a whole lot of work and ensuring that this club is where it is today. Um, yeah, I'm happy to see that she has already joined. Yeah, it's a welcome one.
Thank you.
Yeah, Jennifer, we are happy to have you. So, guys, tonight let's get the drum rolling. Tonight we'll be having a very interesting interactive section on the topic investing in bull markets, the optimism bias. Yeah, it's very, very important. I was eager to join this section. Yeah, because Jennifer is someone that is well versed, well experienced, especially when it comes to investing in the stock market. He has both professional experience and on-field experience, so it's gonna be worthwhile learning from her wealth of experience today. So please join us as I introduce the special one, Miss Jennifer Ifechi Afonsos. I don't know if I got it, yeah?
Yes, it is. Thank you.
All right,
Thank you. I'm
please
just
take the
trying to
mic
set
over.
up my screen and all. Oh, God.
Okay,
I
all
don't
right.
know. Good evening, everyone. Thank you so much, Chitin for the introduction. It's so good to see everyone here. I felt that this topic is something that we needed to understand. We needed to have now that everyone is like coming to the stock market, you're going to make a lot of returns, and everyone is excited. Reminds me of when we entered crypto in 2020 and everyone was like, let's go, let's buy Ethereum, let's buy Bitcoin. And by 2021, when the market dropped, everyone just left. The noise, the shouting and everything was just like it just went mellow. I was like, where's everyone? So and same thing reminds me of 2008 too, when our parents were like, let's buy stocks, they were buying the bank shares and everything. And after 2008, I don't think our parents really talk about investing in Nigerian stock market as much as they did then. So I thought it's just something that we need to understand and see how we can ensure that we don't get burnt like a lot of people have gotten burnt in, and we take advantage of the opportunities that present themselves. Let me know if you can see my screen. uh it's been a long time.
Yes, we
My
can see your screen. Yes, we can see your
lovely.
screen.
Okay, so basically I have just there's something I missed there, and it's the 2020, comparing the 2000 boom and the 2025 boom. But this is basically the agenda. I don't hope to take a lot of time. I hope this session will be interactive. So if you have any question, you can just put in, I could answer as we go, or you can decide that you want to wait to the end of the presentation, before you ask your questions. So basically, the first things first, what's a bull market? I know when I came this thing on my WhatsApp status, I had a lot of people asking, what's bull market? What's bull market? What's bull market? And I said, let me ask you the question. Do you know what bull market and do you know what bear market is? Does anyone are we all on the same page here, or does anyone needs me to explain that part also? Okay, I can see some hands up. Yeah, so the bull market is when everything is going well, you invest today, tomorrow you see a return, you're excited, you're like, okay, where's the next stock? Let me put my money, you invest again. Yes, everywhere is green, like my portfolio is green, So a bull market technically is when the S&P 500 has gotten at least 20% return. So I think the S&P 500 right now is close to that, or if not, it should have gone above that right now. because all sectors, industries, apart from bonds, are actually in the green. No matter the money, the stock you put your money in today, you're going to have a green, except if Trump decides to, come and disrupt the news and all. Generally, you put your money in today, tomorrow you've gotten 5% returns and all. So that's the bull market generally. Everywhere is red. And the opposite we know is known as the bear markets, where everywhere is red. It's like a sea of red. When God decided that let the water turn to blood. That's how it is. The bear market is a sea of red. Everyone is scared. Everyone is like, what's gonna happen to my money and all. But the opposite, which is the bull market, is like, ah, now I can retire in the next 5 years. I even saw someone on Instagram and she was like, she's working towards a £1 million portfolio and all. And I was like, yes, that's the thing that we need, in this market. But then again, we have to be ready so that you don't make the mistake of putting all your money in, and then once there is a small downturn, you begin to get scared. So, like you see, the bull market represents some of the most exciting time and profitable period in financial history. They also present unique challenges because you're asking yourself, should I invest my spare card or should I not? Because you don't want to, what do you call it? You don't want to miss out on the gains that you could get. I've had that battle in the past 6 months. So if you're having that battle, you're not the only one. Yeah. So now let's go to this characteristics of the bull market. So when you look at this generally, I should be in slide mode. Okay. I think that should be all right. Yeah. So when you have the bull market, we are looking here at the FTSE All Share Index. That's and that's what you get to see in the UK generally. It's showing you a period of bull market. That's the period of boom and a period of bear market. So generally, they say that the bull market has averaged almost 6 years. That's 5.9 years, and the bear market has averaged probably 1.1 years. So if we have 5 years of prosperity, probably we have 2 years of downturn, basically. So people are like, okay, even if there's a bear market, we shouldn't be that worried because we're just a year or two of just cries, tears, and all, and then we have a year of boom. But the problem is during that tears, the period of tears, how many are you? How will your portfolio be affected? And it's not a matter of the market just went down. It's a market of what stocks did you invest in? Some stocks will do 90%, 100% downturn. The S&P will probably do -20, -30% downturn. And some might be lucky they invested in the Magnificent Seven and probably just have a little downturn. And then you have the bull market where, since 2020 till now, a lot of stocks have recovered their loss. COVID-19 really brought down a lot of stocks, and many of them have done 100% back on what was before. So that means it depends on the quality of stock you are holding, the quality of ETF, the quality of funds you are holding. So this is generally from.
Hi, Jenny.
Yeah.
I'm sorry to interrupt. Please, can you display your PowerPoint on slideshow because we can barely see your screen.
I see. So it's okay.
See on slideshow.
It's on slideshow, so it's probably showing something else.
Yeah, I think I had the experience one time. And
okay, let me share the window. Yeah. Let me share this one, and let me see when I click on slideshow if it will go. Okay, can you see my screen now?
Yes, this is much better. It's not
okay, much better, yeah.
Sorry, I'm using 3 screens, so I think it took me to the 3rd screen, and that was why it was not showing. Apologies for that. So this is the graph. It's basically just showing you a period of years, and you can see a period of 64.7 years. I think from the time close to the Great Depression to now, this is what you are just seeing flowing through, and you're seeing, okay, if there are bear markets, this is the average is of 1.1 years, and then if there are bull markets, the average is 6 years. So for every 6 years, we should probably be expecting a downturn. And then the next thing you're looking at is another I'm trying to go to the next slide. I don't know. Oh, my God. Okay. I think the next slide is showing. So there's another one that is showing us again now is the S&P 500. Basically, we're looking at the all-time high. The previous one was the FTSE All Index, which is in the UK. Now we're looking at the US. This is the S&P 500. So generally, they're saying that the S&P 500 every 19 years, averagely every 19 years, you have a new all-time high, you have a national peak, and then you probably have a downturn. But the problem is, historical data does not connote the fact that future data will be perfect. With this historical performance connotes that present performance will be, will be greater or is the same thing or not. So 19 years doesn't necessarily mean that it's going to continue like that, because economic indicators are changing. People's attitude to risk is changing. Technical analysis changing, profitability for companies is changing also. So a lot of things are coming into play. So 19 years, will it continue to be 19 years for S&P to have all-time highs? So are we saying that this is the lowest the S&P will ever be for till it gets to 2032, where we experience another all-time high? Or are we saying that this time around, the S&P 500, the bubble that is coming around, the bubble that we are currently experiencing might affect the S&P 500, and it will not reach the 19 years. Probably by next year, 2026, it's going to come down, and it's going to, at least the jinx or the run would actually be broken. The consultants say that stock prices may continue to be at an all-time high. However, people are saying that the current economy, the current performance of the market, the current economic indicator does not mean that it's going to happen. Well, take for example, the Fed now, the US Fed. I know most of us are invested in Nigerian stocks and US. For now, I'll be using the US economy. The US Fed has decided that they will stop quantitative tightening and start shifting toward quantitative easing. What does that mean for you? It means that they will begin to lower interest rates, which they've done in October, and then probably get to have more interest rates reduction towards the end of the year. So November, we should be expecting some, or December, we should be expecting some. The next thing is that money, it will be easy for companies to start borrowing money. The lower the interest rate, the more you can get access to money. And then the next thing is probably the fact that policies will also be changing to ensure that there's money flowing in the economy. The US economy is a spending economy. If you don't spend, the money is not going to circulate, and everybody becomes conservative, trying to save what they have. Now the problem is, with quantitative easing, we don't know if it's positive or negative. That's because inflation has not reduced. Inflation is still high. So if there's more money in the market, there'll be an increase in inflation. That means prices of goods will be going higher and higher and higher. So could it be that it's going to pose a significant problem in 2026 and 2027? Because if it goes to that extent, house prices go up, what the ability for you to get a car is going to also go, car prices are going to also go up, stock prices are going to go up, everything is going up. So with the money in supply, you might still not be able to afford the things that you want to afford. The next thing is the fact that a lot of people have their job, and with the quantitative easing, we're hoping that people get back into the market, into their jobs. However, we are seeing AI coming into play, with businesses saying, you know what, I want to reduce my workers and depend on AI. I can put AI to run for 24 hours. I can't put human beings to run for 24 hours. So I say, even despite the quantitative easing, will people still have the opportunity to go back into the workplace? So those are economic indicators that are saying, despite the fact that the S&P 500 has been averaging new all-time highs in 19 years, are we positive that this particular run is going to continue? So, but I'm also looking at it, like I said, in the past 5 years, we've noticed that there has been downturn. There has been a little bit of correction, mild correction. So even if there is a bubble, the possibility that the S&P 500 might drop 60 70% is low because we've had a correction in 2020 where we had COVID-19 and the S&P 500 was at minus 12%. We also have the 2022 policy drop when the Fed came in to do quantitative tightening, and we had the S&P drop of minus 25.4%. And also in April of this year, we've had an S&P drop of almost 20%. So we've also had bear cases within these last 5 years. So it's possible that there is a bubble, and the bubble might actually last longer than we think it is. However, you need to look at both the supportive side and the contrasting side to ensure that you are taking a good position. So this is economic indicator. This is the graph showing you that this is how the market has performed over a number of years, starting from the great. I'm taking it almost 100 years back. So I feel like that's enough data for you to be able to make informed decision, minus the fact that you also have to run your own analysis. So looking at the previous data of the FTSE All Index, All Share Index, and you're also looking at the data of the S&P 500, you can deduce that, yes, there is a bubble. Yes, even in the bull run, we are expecting a correction of some sort. But I don't think, for me, my own opinion is I don't think we would have a significant drop as much as we had in previous years. Now, let's compare the 2000 dot-com bubble and the 2025 AI bubble. I know you've been seeing a lot of videos on TikTok, a lot of videos on Instagram talking about the dot-com bubble and the AI bubble. And that's because of the fact that both bubbles are created by by tech space, by the technology space. And that's the reason why we have those comparisons. I've been able to do some similarities and I've been able to do some differences. So in 2000, the dot-com bubble, we had extreme valuation. And it's the same thing we are experiencing now in 2025. Take, for example, Palantir, the forward trailing PE, the PE ratio, that's price to earning ratio. When we talk about price to earning ratio, for many people that don't understand the technical term, is the fact that this is the amount the company is generating. This is the price of the share. And we're expecting that the price of the share should be commensurate with the amount the company is making. So take, for example, if the company is making 20 million, the price of the share should probably be around, $10, $15. But when you're having a scenario whereby the price of the share is $150 and the company is just making a tiny profit, you begin to worry. Will this person make profits that will amount to the price of that's commensurate to the price of the share? It makes no sense if you are giving me a profit of 10 million and I'm expecting that you're going to 10x that earnings in future, and as such I'm valuing it at $100, and the first year, the second year, the third year, your profit is not, in fact sometimes you make losses, it's not at par with the value I've placed on you. So it's the same thing that happened in 2000 bubble. Some companies were experiencing losses. Some companies they've not got even £1 as $1 as a profit, but their valuations were very, very extreme. And I think that's one of the reasons why Nvidia and Palantir are being discussed often, because their price to earning ratio are very, very high. People are expecting that the profit from these companies will be 20x what they are generating now. So you can see the disparity in what they believe and in what the company is giving out. Then the next thing is concentration in technology. I know most of us, our portfolio is filled up with 70% of technology shares. Because if your portfolio is not there, it's probably you're now dividend investor or banking shares or probably some industry. But most people that have benefited from this run, this positive turn in market, are actually those that have a large concentration of their portfolio in technology stocks. I've seen a share in my portfolio. It got so painful that I was like, why didn't I invest more? It has done, I think, 200% return, within 6 months. I know that I should sell that stuff because I don't understand what the company must have done to generate 200% return in 6 months. You understand? A lot of people are concentrating their portfolio in technology as they did in the 2000s, which when the market crashed, those in the technology space had their portfolio lose about 80 to 90% of their value. Now, the next thing is unproven returns. I've been reading the news and I've been seeing that a lot of companies that have been investing in AI are not getting the returns they expect. Case in point, was it Klarna or so that sacked a lot of their staff and they tried to use AI and realized that it didn't work. And now they are trying to bring back the staff to the office. They are doing hiring to bring people back to the office. So a lot of companies are doing the generative AI, they are doing the data analysis, and they are doing a lot of AI stuff. And many of them are not yielding returns for them. Many of them have spent money, it's not coming back. I know of another company, they call it Big Bear AI, is in the security space. They've been losing money since they were created, but their stock is I think at $7 now. The stock should actually be around one. Analysts say that the stock should be around $1 to $2, but it's at 7 because people are hoping that one day it's going to turn profits, and is the profit it makes will be commensurate with the stock price. Imagine if for the next 5 years this stock doesn't do that. The next stock, not even the next 5 years. I think the earning report for the stock is next month, November 5th or so. If it doesn't turn a profit in the last quarter, what will happen is that the price of the stock is gonna fall at the same time it fell in the last quarter when they lost money. So many companies that are investing in AI are actually not yet get a return on their investments. Now let's go to the differences. Profitability. Now I know I said a lot of companies are not making money already with their AI investments. Those are companies that are probably not producing their own products. In terms of difference in profitability, we can see that Nvidia, we can see that Palantir, they have had contracts with government, and Nvidia that has had contract with other AI investors in the space. Even Iris Technology, they are already making profits. So some big companies in the space are already making money from AI investments. And why am I saying that this is a big difference for those in the 2000s? Is because in the 2000s, Cisco and others were not making money. In fact, some of them will do IPO. They've not started making money. They'll do IPO. We promise that they are going to make money. And when they are going, their valuation, they are going at 10x the valuation for IPOs. And so when they don't make money in the first year, in the second year, what happens is that investors started pulling out their money. But now we are seeing, Nvidia is making sales from its GPUs. Irish Energy is making sales from its data centers and Bitcoin. Palantir is making money from its government contract. Amazon, Microsoft invested in Nebius, though they've not started making money, but they're on track to make money. So we can see a lot of these big companies that are working in the AI space are making money. And before they go for IPO, they've generated money. Imagine when Anthropic will decide to go for IPO. They will generate income first before they go for IPO. And that's the difference between the 2000 companies doing IPO without making profits first. But in 2005, companies are actually making profit before doing IPOs. Now, the next thing is the real technology. Companies have real and intangible assets. Take, for example, NVIDIA GPUs. I read about NVIDIA and how they were able to capture the market. The main users of NVIDIA GPUs were gamers. They were making their money selling their GPUs to gamers. And that itself is money already for them. And now you can see them going around in their own ecosystem, making contract with this person will supply you 25,000 GPUs. I think, is it Rigetti or Rocket Lab or so? They have to supply them with GPUs also. All of them are having product that they are selling. Those ones then were not having product. They were like research and development in 2000. But in 2005, these people have actual products that you can see and buy. They were not just having patents like in the 2000s. They are having significant physical products that you can go out there, buy and keep and use and all. Then the next thing is broader diversification. In 2000, the S&P 500 had majority of its stock held in technology stock. But today, I looked at the S&P 500. Just about 30% or so are technology stocks in the S&P 500, meaning that it's not yet the top five is Nvidia and Co. Yeah, it's overweighted at the top, but the problem is the beautiful thing is the fact that it has other industry, metal industry, banking industry. We have the energy industry. They are also making returns. I think there was a time in the market, was it not last week or so? Technology was down, but the metal industry was generating profit. So you see now that the mere fact that one part affected the S&P 500, it didn't drag down fully. And that's the thing with 2000. That's the difference between 2000, where we had 80% of the stocks in the S&P 500 being technology stocks, but now we are not having banks having their stocks in the S&P 500, energy, and also right now the S&P is not overweighted with technology stocks. So the 2025 is better at the moment. And so I have a question here. It says, do you think we are poised for a crash? If so, do you think it will be as significant as the 2000? I want you to think about it and then answer the question when we get to the end of the presentation, so that I want to just rush through the slides and then we can start asking questions. So now we have a quote from Ron Channel. He's a very good investor in the market. It says, as the bull market continues, almost everything you buy goes up. It makes you feel like you are investing in stock. Investing in stock is very easy and safe, and that you are a financial genius. And it reminds me of the saying that a captain that steers a ship in calm weather, we think that is a very, very good captain. The test of a captain comes when he steers the ship in stormy weather. So the test of an investor actually comes in bear market and not the bull market. Because anything you put your money now, I have a couple of stocks that I've been looking at. When yes, they're down, it's time to just buy in, but looking at them, some of them have been yielding profit, and I know that if I put there's no way I'm not going to make some cash or something and just quick cash and just get out of it and all. But the problem is that anything could happen with Uncle DJ, and I really don't want to mess up my stuff. So right now it's a bit shaky, but the bull market is still the bull market. You put your money now, by December, if you put it in a good stock, by December, I'm telling you that you're going to get a return on investment, provided that our Uncle DJ does not bring out tariffs and economic issues anymore. And now let's look at the advantages of the bull market. It's not all doom and gloom. The bull market is very interesting. The first thing is portfolio growth and wealth creation. I think at the point in July, I invested in a particular stock. I needed money, and I was like, this stock is going up. I think it was at $11. I invested in it, and by September ending, it had gone up, and I needed cash. I quickly sold the stocks, closed my position on it, and all. That was really, really good because that was extra. And thankfully, I'm in the UK. My investments are in stocks and shares, so they are tax free. That was really, really nice, and it was profitable for me. I made money instantly. I was about to put when I got paid September, and I wanted to put all my salary in it, but I had to use emotional intelligence and say, "Yo, that was just one lock. Don't try it. Don't try it because emotionally you've made money. You're so excited, and you're just like, let me put it on the game, Ponzi scheme. It's gonna generate income for me." So I think that's one thing we have to be careful about with the bull market. Let's not just put all our money into the bull market because it's generating income at once. We have to be sensible about this. So portfolio growth and wealth creation, everything is increasing in price and you're just so excited. Next is positive market sentiment and momentum. I saw someone on TikTok the other day. He invested in this meme stock. They call it Open Door. And I saw that it generated significant returns. I think its portfolio grew up with a profit of 300K in the stocks and shares. And I was like, oh my god, I feel like I want to invest in it. But reading about the stock, I saw it's a meme stock. It's just pump and dump. This person has probably exited. The person entered earlier and exited. But that positivity, you're seeing somebody invest in a stock and it's going 10x. So you're having 2,000% returns. You're so excited and you just want to dive into the stock market, whether you know what's going on or not. So you feel validated because you put your money in one stock and it just skyrockets and you're so excited with the entire thing. And also, that's a positive market sentiment. The next thing is economic strength and stability. You know, in the bull market, companies are acting because you are spending money. Money is circulatory. What will happen is that you are buying things that the company is also producing. So the economy is generally stronger. Companies are releasing good reports. I think Netflix. I don't. I forgot about Netflix. Current earnings. I think the last one they showed profits. My favorite stock, Irish Energy, showed profit in the last one. I think they are going. Their debt to equity is actually low and all. They showed profit, and I wanted to put more money into it and all. And I was like, you know what? Take a step back. This company just pivoted into this space. It's going to the Bitcoin profit is still the one pulling up to this company. Be careful with that. So most times in the bull market, companies are making profit. Nvidia is generating profit. Palantir is generating profit. Everything is looking rosy. You just have to be careful with. You just have to be careful with that. But again, this is one of the advantage of the bull market. Dividend growth and income. Yes, dividend growth is so nice. You see people that have invested in legal and general generating passive income. I saw someone who had about £2,000 in dividend income coming from a particular stock, and I was like, yeah, that's it. And the reason why is because, like you said, the previous one says companies that are generating good profits, they seem to be healthy. So those profits are what they're sharing to investors, and investors are happy about it and wanting to continue investing. The next thing is psychological comfort and reduce stress. Your money is growing, so you're not worried. You're not angry. You're nothing. In fact, if anybody tells you they have a problem now, you are willing to give them money because your portfolio is growing, and that's it. You are very comfortable. Nothing is a problem to you in this life. So that's it. That's the bull market. You have good. It's good news all over the place. Now let's look at the disadvantage and risks of bull market investing. One, overvaluation and reduced future returns. Like I told you, those that invested in the mid would have probably left by now because it might not generate profits by the time they are releasing their quarterly results this November, December. So they are out of it because they know that this is not sustainable. So they pull out instantly. So one of the things you have to be worried about is overvaluation and reduced future returns. When you are looking at a stock that's gone 10x, 100x and all, you need to be careful. You need to look at their financial statements to ensure that this company can sustain the price to earnings ratio. The next is complacency and excessive risk taking. And like I told you, I invested in a stock. It generated income for me. When I got paid in September, I wanted to put all my money into it. And that's the thing. When you see people are making money from stocks, you just want to put your money into it and get your return instantly. Money you would never actually put into it is what you want to do. So at the point, some people actually are borrowing money to put in the stock market. So those are risks that people should actually not be taking if they are well aware of how the bull market is. The next thing is the fear of missing out. Yes, this fear of missing out. I remember when I decided I always rebalance my portfolio. When I was trying to rebalance my portfolio and sell and take some profits, I was like, if these stocks go up, I'm going to miss a lot. But I realized that it's better for me to have some cash because the stock might actually go down. The possibility that the stock goes up is 100%. Yeah, it's good for you because you're in the bull market. But something could happen. And when it happened in April, when Palantir, I invested in Palantir, when it went from $135 to around $80, yeah, I was scared. You understand? A lot of people had invested at Palantir $120. Kept they took lump sum inheritance money, they kept it there. And when it came down, I could see the panic. I used trading to one, so I could see the panic on the platform. Oh my God, my portfolio has gone down by 50%, my portfolio has gone down by 40%. People are crying and all. And that's because generally they won't take this risk. They won't put that much money in it. So the amount of missing out will actually cause you to take excessive risk. The prices are actually at a high right now. So if you are putting your money into it, you need to look again at the financial statement to ensure that this company can actually sustain this growth, and don't you just putting your money into it. Then the next thing is timing risk and market peak. Those who enter the market late, when the prices are already high, you start praying that the market doesn't turn down. You are on your phone reading the news, you are looking at BBC, you are looking at channels, you are looking at Arise TV, wondering what's going to happen. As Trump said something, is your money safe and all? You have to. That's the reason why you don't just put all your money inside the bull market. The next thing is the herd mentality and lack of independent analysis. I've been saying it, review the financial statements of these companies. It is very, very important in the bull market. Companies, many of them lie. They do fraudulent accounting. Many of them don't tell you the true picture of what they are doing. So you look at the news, look at what the CEO is doing, look at what the CFO is talking about, look at what the government is talking about. Look at their financial statement. Be sure that when you want to put your money in this company, you know that the risk of losing your money is high. And if you're putting your money in a company that you know that they are going to get money, they are going to meet these returns, then you are sure that any downturn is just for a short while. You are going to bounce back again. So you have to do your own independent analysis. Then the next thing is ignoring fundamentals in favor of momentum and sudden correction and bear market. So, like I said, you say a particular stock is going up, you don't know what it's about. Take for example, there's a stock that has gone up. They call it Beyond Meat. It's been going up for a while, and it's a meme stock. When I saw it, I was like, "Why is this stock going up?" And I read about it, and I found out it's a meme stock. Yeah, it has gone up. It came down. There's still an opportunity for the stock to go back up because of the poor pump and dump. But I'm not going to put my money in there because I understand that this does not, and again, it comes again with why did you start investing? This does not tie with my objective for investing. So putting my money there, I'm going to be up all night praying and hoping that this stock does not have it. It reminds me of when in crypto market, I kept my money in SHIB and Dogecoin. Elon Musk was pumping the Dogecoin and Dogecoin and Dogecoin, and when it fell hard and it hit hard. And that's the thing that happens in bull markets. People will buy and buy and buy. And if anything happens, if there is a sudden correction, those kind of meme stocks lose 100% of their growth instantly. So you have to be careful of joining people to do things, of favoring momentum. The fact that the stock is going up, you have to have an exit plan for that particular. And now the next thing is strategies for navigating the bull market. So we've learned about the advantage, we've learned about the disadvantage. Now let's look for strategies for navigating this bull market. One, maintain diversification across all asset classes, sectors, and geography. Because of the bull market, I've been thinking that there will be a bear market, and what I did was to start buying some funds that are focused on global indexes, global markets. I know that's the way I diversify my portfolio. I don't want to start picking individual stocks to diversify my portfolio. I pick ETFs that are looking at the global stock market as opposed to only the US stock market. I have stocks that I think I picked some in the tobacco industry. I picked some in the energy industry just to try and mitigate the fact that I have a lot of technology stock in my portfolio. So that's the thing. So if technology stocks go down, I see it in my portfolio. I'm seeing the other parts going up in green. So that's the thing. In the bull market, you need to, it's not just bull market. In every market, you need to learn to diversify your portfolio. You can't just be in one asset class. Because if anything happens in that asset class, you're going to feel the pain. There was a time when I was in defense, and because when there was this speak of war coming up, this and the stocks were going up, and technology stocks were actually going down. And by the time the war concerning Iran and Israel, just dispersed and all, I could see the downturn in the stock and all. So that's the thing. One industry is going up and one industry is going down. That way, when I look at the total growth in the portfolio, I know that it's not going to be. When I check the beta is the frequency, the volatility of your portfolio. So when you check the beta, the volatility of your portfolio, you can see that it's not going to move drastically when the S&P 500 should lose momentum. Then the next thing is pick to a disciplined investment plan. When people want to invest, ask them a question. Why are you investing? One. And two, what kind of investor do you want to be? And that really helped me. I know that I want to invest for retirement. That's the first answer to my question. And the second answer is, am I a dividend investor or a growth investor? For now, I decided that I am a growth investor. Some people have decided that they are dividend investor, and it's fine. It's your choice. The reason why is that I am so eager to make money. Why some people, dividend stocks, I realize that why they grow, many of them don't grow as fast as growth stocks. So, and that's fine for me. At a point in time, when I'm reaching probably my 40s, 50s, I'll decide that, I want to start having dividend stocks. And that's because those dividend stocks can now start paying me in income. And that's it. So you have to ask yourself, why do you want to invest? And two, are you a dividend? And sometimes you can be a combination of both. It's not a one size fits for everyone. And when you are able to answer these two questions, you are now able to make decisions. And anytime the market moves up and down, you are not worried because you are sticking to your own investment plan, to the reason why you decided to invest first. Then the next thing is take profit from positions. Like I said earlier on, I took profits when some stocks went up. I think I read a book that says that when a stock has gone up and probably done 100% or has gone up significantly, you take about 20% of your profit. And you don't take it in the first 8 weeks because the stock might actually continue going up. You just monitor, and when it's probably 2 months, you can then decide that you want to rebalance or just take profit and all. But it depends on you. You might decide that you want to ride it all along, and that's fine. I remember when I started Palantir, I started with 50 and then all the way, and that's because that was the only stock I bought. Don't look at it that was I had money to know. I bought only Palantir because that was the only money I had. And by the time I got to, when it went from 30 to 80, I sold and started buying other stocks and all, and that was how my portfolio grew. And now I think I just have like 10 Palantirs and all, and that's it. That's fine for me. I've invested some in index fund, in ETFs and all. I've just diversified my portfolio because I cannot bear it. But some people, I see their portfolio, just one stock. Nvidia has done returns of 1,000x for them, and they said they are going to hold it to retirement, and that's fine. That's them. I don't feel bad about that because I'm sticking to my own investment plan. So sticking with you, always stick to your own investment plan and try and see if you want to take your profits or not. I saw in the chat earlier today, Ginika was asking, should I take profit or not? I can't tell you if you should take profit or not in your portfolio. It's you that knows the reason why you invested in this particular stock. You can decide that you want to still keep on holding this stock because the company is strong and you to keep on generating profit. And that's fine. You'll be surprised that from 780 it goes to 1,000 naira. And it's beautiful. That's good for you. I'm happy for you. That's fine. But there are some people that are like, you know what? I don't have money. Let me remove some profit from this and go and invest in Oando 1111 and that's fine. So you are celebrating every investor's win, but you're ensuring that you have a plan for your own portfolio. The next thing is conduct thorough fundamental analysis before making investment decision. Like I said, when Beyond Meat and Open Door stocks were rallying, I decided to do my own investment analysis. I was on YouTube, I was on Financial Times, I was reading Google, I was using ChatGPT, I used Claude AI, please tell me more about this particular stock. And when I realized that it's not what I want in my portfolio because I'm investing for retirement, I decided to remove it. It's fine. It's the thing when I wanted to, when Nvidia was 200, then I said I didn't want to invest in it because I didn't understand the product. But as time went on, I went and did my analysis and I saw that, oh, I think there's a possibility. I think one of the reasons why I didn't want to invest in Nvidia was because of the chip industry. The cyclical nature of the chip industry is quite, there are times of depression and there are times of growth. And it's so nasty that if you are in a time, or if it gets a time of depression, you might not survive that particular time. And so I decided to make that decision at that time. And I was wrong. I think it went up and I saw the stock go to 1,000. I can be wrong also. So that's the reason why we don't give stock picking ideas on the chart. You go out there and conduct your own investment. If somebody had listened to me there and say, oh, Jennifer did not buy Nvidia, I'm not going to buy Nvidia, they probably be insulted. And that's the reason why you must make your own fundamental analysis before you make investment decision. The next thing is maintain an adequate emergency fund. Remember when I said I wanted to use my entire salary for the month to invest? It made no sense because I have rent to pay, I have bills. So what kind of risk did I want to take? So it's the same thing with you. You have to have an emergency fund. The emergency fund, they say, is at least 6 months of expenses, your house expenses. You must have it. And that's the reason why once you have something like that, when the market goes down, you are not worried. You're not panicking and selling your stocks. Especially when you have good stocks, you're just buying, the extra cash you have, you're just buying, you're doing what we call dollar cost average. You're just buying the stocks, buying them. And by the time the market picks up back, you are in profit. The people that made money in 2025 are those that bought in 2020 when the market was down. Because if you keep on buying, see, when you look at those two graphs, the market always goes up. And then if you buy stock like meme stock, they don't go up. I don't think Doge and Shitcoin have recovered ever since the crypto nonsense. So if you buy good stock and you're sure that your stock is good, if the market goes down, just keep on buying. That's what you do. You keep on buying because when the market goes up, you will recover your money back. The problem is when you sell. So, and the reason why we ask you to have an emergency fund is so that you do not sell your assets during the bear market should the market turn down. So these are the strategies for navigating the bull markets. There are a lot out there. You can do your research and it should help you to keep your portfolio in strong health. And so here we come to the end of the slide, which is summary. So the bull market offers genuine opportunities. It's not doom and gloom. I see a lot of people complaining that, oh, there'll be a downturn instantly by towards the end of 2025. So you can't predict if there will be a bear market. No. And I've shown you that there have been an average of 19 years of growth for S&P 500, even though it has turned down, but it has continuously grown. And so the bull market offers genuine opportunities for wealth creation. If you want to enter a particular stock now, you're sure that you're going to make even at least 10% of that return because we are in the bull market. So, but the same way, it also presents significant risk because some people take risks that are not good. You don't want to put all your money, all your savings into the bull market. And it's something like tariffs issue or the carry trade in Japan that happened that caused a downturn in last year's market happens again, and then you lose the money that you should be using to pay rent and all. So the bull market offers genuine opportunities. However, you have to be careful you don't take all unnecessary risks. The next thing, the key to investing during this period is maintaining discipline, staying grounded in your fundamental analysis. If you bought a good stock, it's going to go back up. Meta came down to 150 in 2020, 2021. It's up 700, almost 700. I think at the beginning of the year it was 500, but now it's 700. So if you kept on buying in 2021, 2022 when it was down, your portfolio, you should be swinging towards retirement very soon. And then the last thing is by understanding both the disadvantage and advantage of the bull market investing, you can actually position yourself to benefit from rising market and even the bear market should there be a downturn in the market. And I wish you all success in your investment journey. And I hope I've been able to show you how to take advantage of the bull market and also prepare yourself for bear market should anyone happen. And thank you.
Thank you so much, Jennifer. You are Jennifer for a reason.
Thank you.
This is a very interesting class. It's a very interesting section. I actually gained a lot of value from this section, and I feel that many of us who were able to stay to the end actually feel the same way. It's very, very interesting. I think one of the tipping points of this conversation is being able to make what we call defensible decision.
Yeah.
Yes, because for you to choose what you have to invest in, it has to come from a decision to invest in. But is this decision that you have made defensible? Is it something you can defend whenever you are called upon? Not like you are accountable to anyone, but you are accountable to yourself. Do you get what I mean? So this is really very important, and I would be happy to hear from the rest of the participants. If anybody have any questions or comments, this is now to let it go. I'm just here as the man in the middle. So please, if you have questions, we can take 1 or 2 or 3 questions. Please bring it on. Jennifer has a lot in stock for us. Let's not allow her to go just like that, because it might take 5-6 months before we're able to have her back on this section. Please.
Are we all saying that we understood why I went through the presentation and all? Please ask questions.
Well, quite some questions in the comment box, so I'm wondering.
Let's see.
Yes, Mr. Ginika has raised his hand actually though.
Okay, go ahead.
Ginika.
Okay, thank you. Thank you so much, Jennifer. I'm happy I
Fine.
joined today. I think one of the areas I would like to get some clarification is, positioning for the recession. So assuming that we all understand that, okay, this recession is going to come maybe at different levels, how we position for it. One of them, you said, getting exposure in global ETFs, and the rest of them. But I would appreciate if you can mention maybe some sectors, actually some asset classes or sectors, not necessarily the ETFs themselves, but some asset classes and industries that would not suffer so much or will suffer less than others during a recession. Thank you.
So I can't really pinpoint, because in their markets there have been different reasons why the market had a downturn. Like I said, 2000 was the technology bust, but remember the 2008 was financial crisis. 2020 was healthcare issues. 2022 was quantitative easing, economic issues. So I really can't pinpoint which sector is going to come down. But for now, we are looking at technology stocks being the AI bubble that everyone has been talking about. So if you say AI bubble, that means you should be looking at commodity stocks. You're looking at consumer stocks now for you to buy, like your supermarket. That's why you see Walmart, you're looking at those in communications, Netflix and co. You're looking at those in metal, talking about rare earths now. Since China is trying to restrict rare earths, you're looking at those in the rare earth sector, trying to see, okay, if you can put your money there, And so you're looking at sectors that are different from the technology sector and saying, this is where I want to put my money in. There are some, like I mentioned earlier on, tobacco, they don't go that fast, but when the market had a downturn, my portfolio didn't go down as much as technology went down. So we are looking at this kind of industries also. So basically anything this is the AI bubble, anything that does not have a direct correlation with the AI bubble will be a good place for you to put your money to edge against the bear market, the recession that might come in. But then I'm not really a fan of stock picking. So I know that you want to put it in individual stock. I would say for you to be conservative, try and look at ETFs. ETFs don't go down as bad as individual stocks, and or look at funds. They don't go down as bad as individual stocks, and all. So that's it.
Thank you so much. Any other person, please? Time for questions. If you have comments as well, if you have something to add as well to what Jennifer has said, please let's fire her questions, please. Oh, Mr. Joseph, go ahead, please.
Yeah, thank you very much. Thank you. Thank you very much, Jennifer. It was really insightful. I would say be technical for a few people speaking in their defense that, that may not understand some of the technical terms you used.
Don't worry about
Like I was asking in the comments section what IPO is, so they can follow. But overall, I mean, I've been investing for a long time, but I still learned when you were speaking. I can't make reference to all of them because they're going to take another 15 minutes. But almost everything you said in your strategy PowerPoint was just speaking to me. I'm very happy for that, to hear that you're saying all of those things, because we still learn, all of us, trying to improve and prepare for retirement. So my question, not the question I had in mind, but the one I asked in the chat, in the chat section, and I've had that question when in one of the sessions that I held, and we're asking that sometimes we speak from a global perspective and we don't take it back home for the majority of the members who are Nigerians. Maybe not the majority residing in Nigeria, but the majority that are Nigerians and in Africa. So everything you've taught us today, can these things apply in the Nigerian market? Can we apply the learning points and the trends you've told us we should be looking out for that has been happening globally for over 19 years and has repeated? Do these things apply in the Nigerian market? If yes, how do we look out for them? And if no, why?
That's a good one. Yes, some of them do apply in the Nigerian market. I think I really don't understand the Nigerian market as I did then in 2020 before I left. And that's because of the fact that I don't really review the Nigerian market. But some of these strategies actually work on the Nigerian market. So take, for example, when I say conduct your individual analysis, independent analysis, it's the same in the Nigerian market. You don't want to pick a stock that's illiquid. I know someone was talking about they're unable to buy a particular stock or sell a particular stock in the stock market. You don't want to be locked in that kind of a stock when there's a recession. The next thing is you want to ensure that the reason why you are investing in a particular stock is because you are sure that they are going to generate income. And if they don't generate income at a particular time, it's because this is affecting the entire industry of that particular stock and not just that stock alone. So those are the things that are actually going to help. And I said sticking to your disciplined investment plan. I asked you, why did you start investing and what kind of investment investor are you? Are you growth or dividend based? So in Nigeria, I see a lot of movements in the stocks. Why are you investing? Are you investing because you want to are your stocks actually good stocks and do you want to put them as your retirement plan? So, and the next thing, are you a dividend investor? Are you a growth investor? If you are, you look at the stocks in Nigerian stock markets that are doing very well for growth investor and you pick them and put them in your portfolio. And you look at those ones that are dividends. Some people decide dividend stocks actually don't go down as much as growth stocks. So you can decide that, this is my own investment plan. I'm going to invest in dividend stocks in Nigerian markets. And, if there's a downturn, this is going to hold me, keep me afloat, because no matter the dividend stocks will always pay dividend. That's an income for you. Then the next thing I said is maintain an adequate emergency fund. When I'll go back to the 2008 crisis, when the S&P 500 fell in the US, it affected the Nigerian market, and that's because a lot of companies have also invested outside the Nigerian network. So you look at your companies that you're invested in now and check if they have significant assets in the US, in the UK, in China, and co. and see if those issues that are affecting their economy over there will affect them, your portfolio significantly in Nigeria. If it will, what you're going to need to do is probably reduce your exposure to that company that has significant assets outside the country. Then your emergency fund, you don't want a scenario whereby Oando comes down in share price, you're scared and you want to quickly sell, or because you need something, you need money to pay rent and co. You have to sell when the market is down and you're at a loss just because you want to put your house bill, your child's school fees and all. So that's why I say you have to have emergency fund. So when the market goes down, in fact, you are sleeping well because you know that the market is going to recover. The market always recover. And that's the main thing. Then the next thing I said was diversification of you across asset classes. We have got bank shares, we've got energy shares in Nigeria. You don't have to stick to only bank, because I know banks, they do good returns. You don't have to stick to them alone, because if CBN brings recapitalization, many of them which are unable to receive are able to do that, might cause problem. Sometimes some banks are illiquid. I remember when Skybank went bust, then I know people couldn't sell and no. You have to read the news to ensure that you are not just one particular company, and the fact that you are not just invested in one particular sector. EcoBank went down, Skybank went bust, and every other thing. If you are invested alone in the bank, in the banking industry, you will see a significant loss in your portfolio. But if you're invested in other industries, you're fine. If the banking shares go down, the Nestle, Coca-Cola and Co, they are up. So that's the reason why I say this also applies to Nigerian markets. Thank you.
Thank you. Thank you very much, Jennifer. To stress some of the things you said, one is emergency fund. I want to use this opportunity to remind everyone that a key metric for measuring a smart investor is to always have something to fall back on without touching your investment. I mean, you need to have cash. Cash is king, and it's been said over and over again. Even if you don't, you're the person that always wants to go to the market to take profit, but always have cash. Anything can happen to the market anytime. It could crash, it may not even crash, and you may want to sell. The market may not be liquid enough to allow you to sell at that point. And if you're in a desperate and severe situation, you will not be able to get out of it if you don't have something to fall back on that is raw cash. So before you start investing, if you're a beginner, I always advise have something that you can fall back on. If you're out of job, if you have some life-threatening event, and you have no bulk inflow of cash, you should have something sitting, in your bank account that you can go and use to solve your problem. It's very important. And if you tie it to what Jennifer is saying, it's self-sabotaging that you're investing in the stock market. If you're someone that wants to invest in the long term, and just because you have a problem that is likely to be temporary, you're going to liquidate your investment or to sell off a stock that is likely to do well in the next couple of weeks or months. So that's one. Then the other thing is to have in mind, if you're not going to do the main stocks, like you said, Beyond Me, there's a stock. From the name, this is a stupid stock, Beyond Me. But if you're going to invest in actual businesses and companies, actual businesses and companies, whether it's Nigeria, UK, US, anywhere, have it at the back of your mind that for nearly 420 years, the stock market has been in existence over minimum of 18 to 19. I think that's the highest it has gone, 16 years. Like, it doesn't make enough profit of more than 10%. So the stock market over the years will always go up. So the question is, are you willing to stay that long? And are you picking the right stocks that will follow the trajectory of the market? Because if you're picking Beyond Me and you're picking some other main stocks, when the market is actually going up, as it almost always does, then your stock wouldn't even be there in the first place. It must have been wiped out of the market. So I just want to lay emphasis on those two things, and hopefully we're going to look retire really well, like Jennifer. Thank you.
Yeah, sorry. So is it advisable to keep your emergency funds as cash or like high interest yield savings? Because I don't know, cash seems a bit somehow.
Well, if you're okay, Jennifer, go on. I think
continue. You know more about the Nigerian stock market, so that's fine.
No, after you.
Okay, so generally, for savings, your emergency fund, if you will need it immediately, don't put it in the IA savings. But generally, if you won't be needing it immediately, put it in the IA savings account. And that's because not fixed deposit, because people make that mistake and put it in the fixed deposit. No, if the IA savings account, you can withdraw if you want to. And that's because IA savings account, the interest rates on them are almost similar to inflation, are almost at inflation rates. You get, take for example, I put my money in UK here, it's 4% for rate. So IA savings account will probably be 3.8%. If the interest rate is around 22%, IA interest rate should be around 18, 19, 20%. You want your money generating interest that is close to inflation as opposed to just sitting down in your bank account. And don't forget also, GT Bank, Access Bank, they have this nasty attitude of actually removing money from your bank account. So you don't just want them to keep on removing money. You want a situation whereby if they are removing money, the interest you are generating on your cash is actually covering up for that. You understand, for that money they've removed from your bank account here. So always put it in a IA savings account is always better. Yeah. So Sep, you have the floor also.
You've answered it already. Well, I would say what's common sense from traditional investment perspective is to have your money in an account that would give you some hedge over inflation, but will still be very, very easy for you to take out. If you were in the UK or US, where you know that inflation is very low, even if you live in a bank like the ISA or just your normal savings, your normal bank account, you're likely to get 3 to 4%. And inflation in the UK should be around 3 point something now, or less than 4%. Similarly in the US. But if you're in Nigeria or in some other countries, or even Zimbabwe, where 1 billion Zimbabwean dollars, maybe 5,000 naira, so the inflation is eroding everything. Mm-hmm. It's good to put in a high savings account, but know why you should have an emergency fund. And the reason it's like we say emergency, that you can easily get out in the event of an emergency. You want to get your money out and you're not being told any stories. The account, banks even mess up. Like you may want to get your money out of the bank and there's no network. These are obvious technical issues that is commonplace in Nigeria. But I mean, other issues like liquidity, or they're telling you need to do one or two things, you need to sign this, or there's a limit to how much you can withdraw, or if you have any of those restrictions, or you're scared that your money is in a place where it's not well regulated, then I wouldn't advise you to leave it there. But if you have such a place, there's no need calling names now. I think there are 1 or 2 in Nigeria. Then it's not investment wise to leave your money in the bank, because inflation in Nigeria is over 15%. And there's no bank in Nigeria that pays you more than 4 or 5%. So it's not investment wise to leave your money there.
Thank you.
Yeah.
Thank you.
Thank you so much, sir. Thank you so much, Jennifer. This is very wonderful job that you guys are doing up here. I don't even have much question anymore, but I was about to ask a very important question. If I decide to take all my money and convert it to Zimbabwean dollars, and maybe it runs in billions, does that make me a billionaire? because I notice on social media that most Nigerian people, young people, they are called billionaire this, billionaire that. I was like, is it there is some magic that these guys are performing that maybe we don't know? this could work. Does it make sense if I do that way and start answering billionaire?
Well, I think you are. The only thing I would advise is if you're going to do that, then you have to relocate to Zimbabwe. So we call you a proper billionaire. so, so you go there, you experience the economy, and you're a big man there. And it's possible when you go to Zimbabwe, everyone is almost a billionaire. We may now be asking if you're a trillionaire or if there's anyone beyond that, just like the Beyond Me stock. But yeah, that aside, I don't know if you really have a question. I know that's a funny one, but I have another question for Jennifer because I think we still have 3 minutes. So Jennifer, the question is, if I'm new to investing in the stock market, and the question about timing, I don't know much about the stock market, but I'm willing to put in the work. And from the little research I've done, or the questions I've asked people like you and Chisimdi, Ginika on the call, and now is the bull market, would you advise that I go straight into the bull market, or I should wait at a particular time to get into the market so I can maybe maximize my profits? Because I know over time I'll still make profit, but to maximize the opportunities that are likely to be in the market.
Sorry, the question you're asking me is, should you time the market?
Well, something like that.
Okay, so for now, I'll say you shouldn't really time the market. It's basically do your analysis. Take, for example, there's been a little pullback, right? You just do your investment analysis. You look at your financial statements and look at and the valuation. Are you willing to, this one, NVIDIA is at the top now. Do you believe that NVIDIA by December is going to go up? And do you also believe that by October ending November, Trump is going to, bring tariff again? Because this time around, it has affected Canadian markets during the week. Will he bring the discussion with tariffs or not? If he's going to bring it, then I probably say hold on a bit because the market is going to pull back a bit. The next thing is economic indicators. They're about to do quantitative easing right now. So you are looking at there will be money in the economy. If there is money in the economy, stock prices will skyrocket. So now could be the best time for you to buy, in pending that there will be a boom in the market very soon due to quantitative easing. The next thing is, when is the earnings call of this stock? I mentioned Big Bear AI. I've been trying.
What was an earnings call?
Earnings call is when the company will come out and say, for the past 3 months, this is what we've done in the company. We have made such and so amount in revenue. We've made such an amount in customers. And now at the end of the day, at the end of the 3 months, we've made profit or we've made losses. Okay. Do you understand?
Yeah.
So that's what earnings call is. Companies will come out, the CEOs, the CFOs, all of them will come out and like report card will say, this is my report card for the past 3 months. And then if the company is close to doing earnings call, I would say do not invest yet, because earnings call is a volatile period. You've seen a scenario whereby the company will say we had profits, but the stock market will still the stock for that company will still go down. That's because they're like, it doesn't make sense for you to have made this amount of profits. You should have made more. Do you see? So there are scenarios where you see Tesla made profit and then the market just went down. That's because they're expecting Tesla to probably make 20, but it made 15. So those are scenarios. So during earnings call, I always say, if you want to probably invest a little bit, but don't invest all your money in the stock at that period in time. You just want to see how the market will react to earnings call at that particular time. Then the next thing you want to look at is sentiment. What is people's sentiment around this particular stock? Meaning, how are people interacting with this particular stock? Are they bullish? When we say bullish, means are they hoping that the stock is going to increase in price? Do you understand? Take for example, there was this particular stock I bought once. They call it Seals. It's a quantum stock. People when it was, I think I entered around $4. It came down. I stayed in the stock till when it came down to around $2. I was bearing the losses, and that was because I had a strong belief that this thing was going to bounce back. This particular company was going to bounce back and all, and I kept on doing DCA. The stock now went up to $7. Do you understand? And I made my profit and closed that position. That's it. You might be, so you're looking at the particular stock, and are people really bullish about this? I went on YouTube, they were like, this stock is going to go high. I went on Sister, so they said this stock is going to go. So you're looking at that sentiment around the stock, that it go up. If it's going to go up, you can enter, make a position into it. However, what I do to tell people is, should you put lump sum or should you do dollar cost averaging? Dollar cost averaging is you buying a stock small. Today I buy it 100 pounds. Tomorrow I buy another one, because I believe that during the course of this month or because of the year, it will go up and down. So you don't want to put all your money at once and then the market goes down and you don't have any money to put into the stock. So those are the scenarios whereby you can think about them and say, okay, any call is now, maybe I should just step back. Oh, the quantitative easy coming, maybe I should go in all in. And so like I said, I can't really tell you what to do. You are just to look at these economic indicators, look at the stock and say, okay, good, I believe this is what is going to happen. Let me take a stance. I say, if you're scared, you do dollar cost averaging. If you are bullish, you just put the entire lump sum in it. Yeah.
Yeah, thank you very much.
Yeah, thank you so much, Jennifer. Just to add a bit of, listening to what you just said. I think as a beginner who wants to invest in the stock market, and then when you hear that there's a bull run or you hear that the market is performing very well, I think there's this adrenaline that you want to get in so you'll be able to make as much profit as you can at that time.
Yeah.
You have talked about so many factors, but there are other things that a beginner needs to consider. I heard you talk about fractional investing. You talked about the fundamental part, which is the fundamental analysis, where you have to do some kind of level of analysis and all. But overall, I've in my own personal time guided a lot of people who are just getting into the stock market, and I've identified one thing. People are more interested in what they want to invest in before doing some kind of personal evaluation to understand this is where I stand financially. This is my level of risk appetite or risk tolerance. This is the level of risk I can expose myself with, because some of these things are foundational in helping a new beginner make an informed decision on the type of strategy he or she is going to utilize. And again, the investment horizon. Because that strategy is very important. Whether you are going to be conservative, you are going to be moderate, or you are going to be more aggressive. So depending on the type of strategy that you want to involve, it will help to also determine the time horizon you are going to give yourself when it has to do with investment. So if you have done this personal evaluation and then you choose a particular strategy, let's say for instance, you want to be conservative. You are not interested in the news. You're not interested in where the stock is going to. You want to play safe by investing in well-known companies, well-known profit margins, a kind of historical data that supports your decisions, well-stable, high-valuated companies. That is your interest because you want to play safe. A combination of ETF and dividend-paying stocks perfectly is good. But if you're this kind of individual who, just because you listen on the news that there's a bull run and the stock market is doing well and you want to put your money into it, I might link you to someone who is very aggressive. And then when you are aggressive, you barely make a defensible decision. Like I said earlier, these are all decisions, but is your decision defensible? Is it coming from a level of in-depth analysis, right? So if you are there and you are more aggressive, there are a number of factors that you need to actually consider. you made mention of if you want to invest small, or you want to invest a lump sum. If you want to invest a lump sum, my advice for the person is to determine his or her margin of
Yeah.
safety. Yes, I don't want to use the industry standard because there could be industry standard. Personally, I do my own margin of safety. Should I invest now, or should I give it time to invest at when the price is a price correction to up to 25% or 15% or 10%? And this decision regarding margin of safety is guided by my analysis, the analysis that I've done over time, that when this stock moves this way in upward trend and there's a little correction, it gets to 15% downwards, and then I can lock in the price and get a good margin of safety. This is also important. I used to tell them, don't, because when you are a beginner, you may not be able to understand the industry terms and all those things. You can give yourself a lock-in on doing maybe 15% or 10%
Yeah.
margin of safety. So you get in at a good price because you are investing in lump sum. But if it is fractional investing, obviously, is someone who is moderate. You know, you don't care about the wave. You just want to invest every other month. So there's a way everything balances out when you invest every other month, because the prices are not the same every month. So one month you might buy more, and then the other month you might be bare. The other month you might buy at moderate price. At the end of the day, when you take the average price of different positions that you have opened, you will see that you are at a particular point where you are safe. I'll give an instance. Earlier last year, I was investing in SMCI, Super Micro Semiconductor Company. Yeah, very sweet one. I was making a good money from it, very excited. So I kept making money every other week because it goes up and down, up and down. Yeah, kept making money. Then I decided to lock in to make more money. Greed came. So I wanted to lock in to make more money. So I got a lump sum of cash in dollars and I decided to buy more SMCI just so I can make more profit, you know. So I now put the money, and then they started having all the crises that started, you know, all those crises to an extent that they got removed from NASDAQ 100. You know, there was a point they even considered delisting them from the
Yeah.
stock market. It was very painful. I started reading about delisting processes and all those stuff. My heart was panicking. You know, but US is US now. So the company they have to be a rescue somehow. So when there was a rescue and the news was becoming a bit positive than what it used to, you know, I decided to get another one because I know I cannot wait for the market to get back to where it was, because we're talking about a stock that lost almost 70% of its share value as at the time I entered the market. So I decided to like invest fractionally, like buy at that price, and then the market went up. That the gain I made at when the price was lower now covered for the loss I made when the price became higher.
Yeah.
So I sold. I didn't lose anything entirely. That is the importance of fractional investing. You know, for anyone that is here that is a new person, these are ways you can go about. There are many ways you can go about these things, but the best is to be more moderate. Think about the frequency of your investment. Think about your strategy. Think about your time horizon, and think about, you know, setting a good margin of safety for yourself, not the industry standard, not the mathematics, not the statistics. Just do it yourself your own way. Thank you.
Thank you so much. Thank you so much. Thank you. And I think that there's one thing that you said, which was the stock lost a lot of value. But what you did was when it came down, you bought in. I know my husband used to say a stock that goes down went down 50%, 80%. But when it's going back up, it's going back 100%. So if a stock from 100 went to 50, it lost about 50%. If you buy at 50 and it goes back to 100, you've gained 100% of your money. You understand? It's the same thing. You know, you buy, you just keep on buying and buying and buying. When it goes up, you just tell instantly, like, let me just close my position. And then you see that your average is now lower than than what you had before. So I think the main thing that spoke to me this year was remove emotions from trading. And that's it. Just remove your emotions. Because when the stock goes down, be like, the world is against me, and and then I just feel moody, I know. But when it goes down like this, my brain is already thinking, do I have extra cash Is there something I can spare? Let me just buy so that when that means the price I bought it was very high. So if it has gone down, let me just buy it, bring down my average. And when it goes back up a little bit, sometimes it just needs to do probably 5% or 10% upward, and I make my money back. And you just remove your money, the money that you added, and go back to other things. So don't let your decision be emotional. No, let it be strategic. Anything that happens in the stock market, just see that it's happening in the stock market and just take a step back and say, okay, you know what? How can I do all this? There are some times that I buy a stock, I sold it, and I was like, I woke up in the next morning, the stock has already added £10. I was like, what? Bad luck, what kind of bad luck? You know, quickly rush and put my money, you know, to like the end it's gonna continue going up. But I used to take and I take a step back. I'm like, okay, it has gone up. What made it go up? And no, if it goes up significantly because of sentiment, it will surely come down. If it doesn't come down, no problem. I wait it out. I get some money and just buy at that time. But when I'm buying, it should be because I want to buy it and not because of the fact that I'm angry that I sold the stock early and I'm just buying it. So that's it. Just remove emotion from investing. It's not gambling. It's not day trading you are doing. You are investing. Once you remove your emotions from it, you start taking logical decisions and you're fine in the markets.
Thank you so much. Thank you so much, Jennifer. Please, we still have one more slot for any question. I think
there was one question now. Did you guys answer the IPO question?
No, I was just asking to help a few other people understand. You know, I thought like I saw IPO on your presentation and you mentioned IPO without, explaining what it is.
Sorry.
Yeah.
Sorry. So IPO is the initial public offering. So a company says, I'm doing it's just like your SpaceX now. It's indoors, it's making money. So one day it just says, you know what, I want Gbogbo to not come out of my stocks. I want to go out there. I want to put myself out there. Everyone should come and buy. So the first time it goes public and asks people to come and buy shares on the stock exchange, that is what we know as initial public offering. So right now, everybody is waiting for ChatGPT to open AI to come to the public. Once it comes to the public, you will see that insane valuation, and people buy it cheaper and it just goes up. Some people buy it when it's at the top and it keeps on going up. But the first time a company says, you know what, I want everyone to come and have my share, and they go outside, that's known as initial public offering. That's it. It's like coming out ceremony. Yes.
Thank you.
Yeah.
All right. Is there any more question, guys? In the absence of any question, I'll also invite Jennifer to give you some kind of closing remark, so we can just round up. What's your advice for us? What's the key takeaway for us tonight, please?
Okay. And the key takeaway for tonight really is do not be scared about whether the bull market will end or it will continue. Just continue doing your own independent analysis and taking a position in all the stocks that you have. And also as well diversify if you're scared that your portfolio will go significantly down if there's a bear market. The main thing I've said is remove emotions from it. Think logically, and at the end of the day, your stock, as far as you buy good stocks, good ETFs, good funds, they always go up, regardless of if there is a downturn. Thank you very much for listening.
All right, guys. Thank you so much for coming for today's section and for staying through to the end. I want to appreciate you all. And I want to also appreciate all our sponsors, the people who has been doing a whole lot behind the scene that don't want their name to be mentioned, supporting us with their time, with their knowledge, wealth of experience, and even financially. It's not an easy journey since we started this S&P Finance Club. A lot has gone in. We've been trying to improve on the standard, on the level of delivery, and I hope that we're going to do better going forward next year with your input. We're still open, to more support. It's not just financially. It goes beyond money, to your advice, suggestions on how we can make things work, on how we can make this platform a formidable one in spreading the gospel of financial literacy. It's actually gospel. Because if we have a financial literate generation, some of the things that we see happening in our society or all around us will cease. Everybody will focus more on their business. Do you understand what I mean? So I am very, very, very grateful. So on behalf of S&P Finance Club, we say thank you. We say thank you to Jennifer as well. It's not easy having you here preparing this slide without even collecting a dime. You can imagine how much she'll be paid if she's doing this in UN section. Just imagine. So, but these guys has been doing a lot for us. So we are truly grateful. Thank you, Mr. Sepp, our cherished founder. Thank you, Chika, who has been the community manager doing one of the most work in terms of all the techie things that we are seeing. We are truly very grateful. I remain my own humble self, Chisim Joko, the co-founder of S&P Finance Club. I hope to see you guys again next month.